So first off, I'm going to start off this morning with drilling rigs because I want to explain what you're going to experience most likely over the next 60 to 180 days. Oil companies had their budgets in the last quarter of last year, record earnings. They prepared the 2023 budget. They looked at strip prices going forward for gas and oil, and they started planning what they're going to do in the first, second, third quarter. I suspect they'll be making adjustments to the second and third quarter relative to lower gas prices and relative to at least what has been the last 45 to 60 days, lower oil prices than what they had budgeted for in the last quarter of 2022. So that being the case, we started seeing some erosion in the drilling count, and that drilling count has been, 2, 3, 4 wells a week. Saw a little increase last week, but the increase was in areas that are not prone to be what I would call poor areas of exploration, meaning that when prices are being pushed down, like they have been, oil companies start determining what's our A plus locations, what's our A location, what's our A minus locations, and definitely if there's any B locations, those locations are basically put to the sideline for a later date. Now, all of them could be A plus in quality. All of them could be A plus in geology. All of them could be A plus in terms of minerals. But what happens internally to an oil and gas exploration company is they're looking at more intrinsic details about where they drill, which wells they'll postpone or push off to drill at later dates based on factors that are not obvious to the naked eye. Those things are which mineral lease collectively gives them the highest percentage to the oil and gas working interest owner. They want the biggest chunk of the pie. Which locations have the greatest takeaway capacity, meaning oil transport, water transport, crude oil, natural gas transport. So they are looking at things that are going to affect the bottom line, the highest profit margin, the easiest means to get their oil and gas that they produce from the new wells to the market, all that goes into it. So they might have 10 prospects that are all ranked A plus. The number 9 and 10 have smaller diameter gas pipelines, which means when they drill the well, maybe they can or can't get the gas in the line. They can add a compressor, but the compressor only makes sense at $4.50 gas, not at $2.10 gas. Maybe they're drilling in an area that's predominantly natural gas, has good condensate, but with gas prices currently down around $2.10, they may want to push that back to the last quarter of this year and rotate another well more in the oil window. Or they may just simply say, we'll postpone drilling that for the next 6 months until that drilling contractor comes down off his day rate from $37,000 a day to rent that drilling rig. We want them to come down to $27,000 day rate. So having that rig sit there idle is a way of letting the vendors know we're not in a hurry. We have the cash. You have a rig, you have payroll, you have crews, you have overhead. You're going to have to come down off your price to encourage me to go drill at $2.10. So there's a lot of vacillation in the market. The rigs definitely are telling us where the activity is. It's definitely telling us who's going to continue drilling. It's going to tell us who's going to drill where and why. It's going to tell us some of those fringe plays, because like an accordion, when the prices of commodities get softer, then you start to see those rigs get in and they're trying to avoid any kind of soft costs like utilities, easements, roads, pad sites, electricity. They're going to stay right where they have the highest effective deployment of capital for the highest return. That's what we focus on in conjunction with everything else in the minerals we buy. So we look at the rigs. That tells us what's going to happen 6 months, 12 months, 18 months down the road. And it's because we spent 37 years of my career on the drilling side. And what George Gruneau, myself, and the collective team is doing is analyzing those oil companies and how they're going to react today, tomorrow, in 90, 180 days based on everything from vendor cost all the way down to the commodity prices. Okay. So this morning we got a nice little surprise. We woke up yesterday morning early. Saudi Arabia announced that OPEC was going to cut back 1 million barrels a day. Keep in mind, there's been promises since October they were going to cut back on 2 million barrels a day. We talked about the fact that Russia, due to all of its repositioning of its crude oil, trying to sell underneath these sanctions by the U.S. because of the war with Russia and Ukraine. We were looking at probably a minimum of 2 million barrels a day, probably closer to 3 or 4 million barrels a day out of the normal flow of global oil across the world. Saudi Arabia gave a surprise yesterday. Not only did they come out and not say, hey, we're rethinking about adding supply. The opposite came out, and they basically said, we're going to cut another 1 million barrels a day. Saudi themselves said they would back off 500,000 from their own production daily. And the other OPEC members are meeting tomorrow to decide who's going to cut back, how much they'll cut back, will they participate with the overall OPEC philosophy. A couple more slides from now, I'll tell you what's going on. Bottom line is, those cuts have not taken place. Those cuts are coming in April, May, June. But the market has reacted because what they're doing is they're going out buying futures contracts. They're trying to participate in what they believe to be a shrinking supply. I believe the total number I saw yesterday, when you add in Russia, pullback by Saudi Arabia and OPEC, all things considered, it's 3.7% of the global oil supply is being pulled back and taken out of supply over the next 90 days. Now, some people will argue, well, that's probably going to be equal to the economic recession pullback, meaning the economies around the world are slowing down, inflation's getting higher, and so the anticipation is there'll be less consumption. I don't think there'll be 3.7% less consumption. I don't believe they're pulling back because of that factor. I think if we go back to the middle of last year, Saudi Arabia said, we are very comfortable at $90 oil, which means what? As the markets have moved, as the cost of inflation, the cost of capital, the cost of commodities in the macro view, Saudi Arabia and OPEC believe that oil should be sold at $90 a barrel because that equals risk, inventory, volume, extraction, midstream, et cetera. So we are moving to a new regime, what I would call a comfortable basement level price of probably north of $90 a barrel. Now that's the dream world, but you will have dips down to the 60s. You'll have dips back in the 70s. But at the end of the day, over, let's say, a 10 or 20 year period, they're clearly saying we intend on moving the base level price of crude oil up to $90 or higher. It's a very comforting factor for us. Okay, so this announcement yesterday gave us about a $5 or $6 pop in oil. But let me just share with you what really happened. In 10 days, we've gone from $67 a barrel to $80 a barrel. It's about a 25% increase in overall commodity value. That's a nice jump. I don't think the market's done. But I'll explain a little bit later why I think we're not going to see the real robust side of this price for probably 30 to 70 days, somewhere month and a half, something like that, maybe 2 months. All right, natural gas is still lagging. I still think you have to be prepared for seeing $1.65 to $1.75 natural gas. Why is that? We're hitting springtime. Everybody's starting to see a little less winter. It's sunshine. Everybody's out laying in the park this weekend. You're not sitting at home with a blanket on your lap trying to heat the house. You're not sitting in the house with 85 to 100 degree weather, putting on the air conditioning. You're not seeing people using all the different equipment. They're basically in springtime, which is, hey, I'm outside, I'm rowing a boat, I'm fishing, I'm doing things that are non-consumptive for the most part in a normal consuming fashion for fossil fuels. Well, we already have this lag of EU trying to buy our LNG. As a result, we have lower demand, normal supply, seasonal transition, which is always going to happen every single year during this time of the year. And what it's doing is suppressing gas. Now, it's not going to stay there because you have gas plays like the Marcellus, you have gas basins like the Haynesville. They're looking at break even, maybe $1.75 to $2. So they're getting down really, really thin on profitable gas. And my guess is they're going to slow down their drilling. They're going to choke their wells back, and they're going to start constraining some of their flow, which is going to hurt their cash flow, hurt their stock value. But at the end of the day, they're not going to give it away. So just letting you know, there are significant natural gas basins that are being dramatically economically affected as a result of this gas price being down below $3. We don't really have that same kind of pressure in our wells in the Anadarko Basin because even our gas wells in the high pressured area are producing such quality BTU gas, maybe 1,050 to 1,200 BTU gas. What that means for those of you who don't know, 1,000 BTU is dry gas. You can put it in a line and burn at your house and your fireplace. Anything above 1,000 means it has liquids. The higher the number, the more liquids per 1,000 cubic feet you have. That means they're taking that gas and squeezing it, and they get liquids out, which is propanes, butanes, and hexanes. So a pure dry gas, you squeeze it, it's only gas. You get 1,050 to 1,500, you're getting a lot of liquids. That's important because as there's a shift in the Anadarko Basin, we're not necessarily giving up liquids, We're not necessarily doing 100% gas. We're saying that, like a menu, they will move from higher pressure, mostly natural gas wells with some condensate and liquids. They'll move back further into the liquid part. And guess what? We happen to be in the tenderloin of the basin. So it's not going to really affect us. We don't like the lower revenue from gas. We have really strong oil prices. We have really strong production. So we're balanced. All right, US dollar. This is something that's going to be important. So as we go through the price of oil and gas, I want you to understand historically, you have this kind of inverse relationship to the dollar and crude oil. If you look back to 2008, when we hit record prices for crude oil at $145 a barrel, the dollar had slipped to 77. It was completely opposite. Well, now you're seeing this erosion in the dollar. You're seeing this increase in oil. It's following the same pattern. The problem with patterns is it's like watching a movie and you only see 60 seconds of the clip. You only know what happens during that 60 seconds. So for me, I'm not looking at this month or next month or last month. I'm looking at where we're at in the last 3 years, where we're at in the cycle, and what that looks like going forward 36 to 60 months. Because historically, when you look at major changes in commodities and major changes in global demand, and you also combine that with financial instruments being under stress or having something such as a low cost of capital we've had in the last 10 years, it directly affects things like commodities such as oil. It also directly affects things like currency. So today, it's my belief the United States has spent all of its cards. We've thrown all this stimulus money. The whole world's out running around trying to grab those dollars. The demand for dollars drove it to 114 and some change. Now it's pulled back to 102. There is a strong argument, in my view, that the 102, 103 is going to continue to deteriorate over the next 36 months. It is very likely, with all things considered, this day to day, April the 3rd, 2023, it's very likely in 36 months or less, you will see the US dollar below 80. You'll see crude oil above new records of $145 a barrel. And you're going to see this growing spread as the dollar will be less desired as currencies start to gain strength against the dollar. And with China's pressure by making other countries consider or transfer from a dollar related economy to the yuan or some other type of currency, there'll be less demand. This affects everything from export, import, and also definitely affects the crude oil and natural gas industry since we sell and everything's tied to the dollar. Let's see how it goes. All right, Bitcoin. I only throw this up here because so many people are in Bitcoin or somehow related in the industry, and they've got, Bitcoin, they got mining, etc. But at the end of the day, let me just tell you. So the Bitcoin rose from, the ashes of 15,000 coin to 28,000. The traders are making money going up and down. I still go back to the same comment is I don't even really understand the crypto. I thought I did, and I had enough. I made a nice profit, and then I bought in some more. Here's the bottom line. It would be seemingly obvious to me that as the dollar deteriorates, cryptocurrency is going to do better. It's an alternative asset class for currency. At least that's the assumption by millions of owners of the different coins. But at the same time, I don't have any intention on being in an industry that cannot assure me where my money is, who's holding it, with some kind of regulation. Now, I don't like regulation, but I like regulation to the point that I can have some kind of level of confidence and reporting that tells me whoever is housing my money is not a crook or an FTX and stole $20 billion. So until that gets hammered out, I'm probably not going to be a Bitcoin participant. Am I tempted? Of course I'm tempted. Am I tempted when I see a spread? Of course. Do I think Bitcoin can rise back to $45,000 or $60,000 a coin? Yeah. My original concept was I thought over a decade you could have a coin like Bitcoin up to $1 million a coin. I think the confidence level from investors has dissipated by 75 or 80%. I also believe with the lack of liquidity in the market, meaning less dollars we all have less dollars. Real estate's not performing. Different parts of our portfolio are not doing as well. So what you're going to see is people are going to be a lot less risky in their investment decisions, and they're going to be a lot less willing to put money in things they can't control or they can't get their hands on or they don't feel confident about putting in there. And as a result, you'll have less and less people involved in crypto, which should drive the price back down again. As oil goes up, I think Bitcoin is going to go down. We'll see how it goes from here. Is it a probability it can still go below 15,000 a coin? Absolutely. Because those people who own it may have to cash out to pay for debt and real estate and foreclosures, et cetera, because the storm is barely coming on shore and it is a category 5 plus.